Hey there. Let's talk about one of the biggest financial moves you can make, selling your home. The goal here is simple, right? You want to keep as much of that profit as you possibly can. So we're going to break down exactly how to do that.
So, is this you? Are you thinking about putting that for sale sign up? Or maybe it's just something on your radar for the future. Either way, you're in the right spot because trust me, what you don't know about taxes can take a huge bite out of your final check.
And I do mean a huge bite. I mean, can you imagine seeing $50,000 just gone? Poof. Carved right out of your profits and sent to Uncle Sam. It happens. But here's the thing, it doesn't have to be that way. With a little bit of know-how, you can really shrink that number way, way down.
And this right here, this is our game plan. We're going to walk through 5 key areas where you can find some major tax deductions. We're talking home improvements, all those selling costs, the big one, capital gains, and of course, mortgage interest and property taxes.
Okay, let's start at the very beginning, way before you're even thinking about open houses. The work you put into your home now can actually pay off big time when you're filing your taxes later.
Now, this is built around a really cool idea called your cost basis. Just think of your home's original purchase price as its starting value. Every time you make a major value-adding improvement, you get to add that expense to the basis. Why does that matter? Well, a higher basis means a smaller taxable profit when you sell. Simple as that.
But, and this is absolutely crucial, you gotta know the difference between an improvement and a repair. A full kitchen remodel, that's a capital improvement. It adds real value, so you can add its cost to your basis. But just fixing a leaky faucet, sorry, that's just maintenance, a simple repair, and unfortunately, that's not deductible.
All right, let's fast forward a bit. Your home is listed and the process is rolling. Now you're starting to rack up costs that are directly tied to the sale itself. You're going to want to keep every single receipt for these.
The good news is that pretty much all the costs of selling your place can be deducted from your profit. You've got the big one, of course, the real estate agent's commission, but don't forget about things like lawyer fees, what you spent on advertising, escrow fees, and title insurance. Every single one of these chips away at your taxable gain.
Okay, time for the main event. This is the one that makes everyone a little nervous, capital gains tax. But listen up, because this is also where you'll find the biggest savings.
So first, let's just get the definition straight. What is a capital gain? Well, it's just the profit you make. You take the final sale price and you subtract your adjusted cost basis, which, remember, is the original price plus all those value-adding improvements we just talked about. That difference, that's your gain.
And here it is. This is probably the best news you'll hear about taxes today. The IRS lets you exclude a massive chunk of that gain from taxes entirely. Now, you do have to meet a couple of key rules. You need to have owned the home and lived in it as your main home for at least 2 of the last 5 years. If you check those boxes and you're a single filer, you can exclude up to $250,000 of profit. And if you're married filing jointly, that number doubles to an incredible $500,000. For most people, this one rule completely wipes out their tax bill. So how do you figure out if you're under that limit? It's really just a simple 3-step recipe. First, add up your cost basis, original price plus improvements. Second, figure out your net proceeds. That's the sale price minus all those selling costs. And finally, just subtract the basis from the proceeds. Whatever's left over, that's your capital gain.
But wait, we're not done yet. Beyond the big deductions tied directly to the sale, there are a couple of other powerful ones you can take when you do your regular taxes for the year you sold the house.
So, just because you sold the house doesn't mean you lose out on the mortgage interest deduction for that year. Nope, you can still deduct all the interest you paid for the months you owned the home, right up until that closing date. And you guessed it, the exact same logic applies to property taxes. You paid them for part of the year, so you get to deduct that portion. Your closing paperwork will even show you the prorated amount, which is just a fancy way of saying the exact slice you were responsible for. Let this one sink in for a second. This isn't about finding some shady loophole. It's just about knowing the rules. Every dollar you can legally and correctly deduct is a dollar that goes right back into your pocket instead of somewhere else.
All right, we have covered a ton of ground, so let's bring it all home and put it all together with one final, clear takeaway. Okay, here they are again, your 5 key deductions. Home improvements, they get added to your cost basis. Selling costs, they get subtracted from your sale price. Capital gains exclusion, that's your huge tax-free buffer. And then, for your annual tax return, don't forget your mortgage interest and property taxes. Now, look, this explainer gives you the power to ask the right questions and to know what to track. but tax laws can get tricky, and everyone's situation is a little different. That's why it's always a smart move to chat with a tax professional. They'll help you make sure you get every little detail exactly right.
You put in the work, you built that value, that equity in your home. Now you have the knowledge to protect it. The only question left is, are you ready to put that knowledge into action?